Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. I don't think people are paying enough attention to the big cycle.
Ray Dalio recently gave an exclusive interview where he warned investors that there could be significant pain in the stock market in 2023 and 2024. According to Dalio, stocks as a group may perform poorly, and he believes that cash currently offers a better relative return. Ray Dalio, throughout the interview, described the long-term debt cycle and how it affects us as we participate in the economy, which helps to explain what the economic environment may look like over the next few years. Ray Dalio is one of the most successful investors of all time, with a net worth of $19 billion, primarily built through founding Bridgewater Associates that is currently the largest hedge fund in the world. In today's discussion, I will share some clips from Ray Dalio's latest interview, where he talks about the long-term debt cycle and which assets are likely to perform well going forward from here. Ray Dalio is one of the experts I rely on to learn about the economic machine. He does an excellent job of simplifying the complexities of the finance world into a few key building blocks and factors that ultimately influence what we see and what happens. There are three essential fundamentals that drive the economy, which consist of a productivity trend, a short-term, and a long-term cycle of debt. And an economy is basically a collection of different currency exchanges for products, services, and financial assets, like stocks that take place between individuals, companies, and governments. Productivity is the easiest component to understand. As time passes, humans become better at making products and services through an accumulation of knowledge, which ultimately raises our living standards. Ray Dalio refers to this as the productivity curve. For example, the knowledge we have learned in developing motor vehicles has led to notable advancements in supply chain efficiency that's resulted in lowered costs of goods and services and an overall improvement in our standard of living. While output remains the key driver of long-term economic growth, in the short term, it is debt that causes the fluctuations we observe in the economy. This is due to the fact that when we acquire debt, it allows us to spend more than we generate. But when we have to pay it back, it forces us to spend less than what we produce. The short-term debt cycle typically lasts for 5 to 8 years. During this period, the increased use of debt leads to higher spending, which can cause inflation if it exceeds production. In response, the central bank raises interest rates to slow down inflation. This makes debt financing more expensive and reduces spending in other areas of the economy. This leads to lower prices and ultimately a recession. The central bank lowers interest rates when inflation's not an issue, but then the short-term debt cycle begins again. Since 1945, there have been 12 and a half short-term debt cycles, with the last one starting in 2008 during the global financial crisis. The cycle ended in 2020 when the pandemic caused interest rates to drop to zero again. Recently, we are in the middle of a short-term and also at the start of a long-term debt cycle, which usually takes place over 75 to 100 years.
There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
The start and end of these long-term debt cycles that occur over several decades can have significant consequences for investors. Furthermore, very few people alive today would have experienced such cycles before. Although the amount of debt may increase and decrease over short-term cycles, it tends to accumulate over multiple cycles. In his latest memo, Dalio noted that debt liabilities and assets have almost always increased during the expansion phase of the long-term debt cycle. This has always been the case until the burden of debt became unmanageably high or the debt assets became intolerably low returning, at which point there are significant reductions in debt obligations and debt assets that happen through a combination of debt restructurings and debt monetization. These are the major times of debt trouble. The simplest method to fully understand what Dalio means by these long-term cycles is to simply walk through the most recent cycle, which started in 1945 and just ended now. The long-term debt cycle has 4 stages. So the first stage began in 1945 when World War II came to an end, and the United States took control of both the economy and geopolitics by securing its place as the world's most influential military and economic force. The US dollar was also backed and tied to gold from 1945 to 1971, which allowed you to basically exchange your dollars for gold at the Federal Reserve if you so desired. During this time, the U.S. overspent and used debt to finance that overspending, resulting in 5 cycles of short-term debt. Over time, some nations that had large amounts of U.S. dollars began to trade those dollars for gold after realizing that the U.S. had far more claims to gold than there was actual gold available to do so, and this effectively resulted in a bank run in the United States. Because the United States did not have too much gold to trade for those dollars, they basically decided to just break the linkage between the US dollar and gold, which run to the foundation of today's fiat money.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
And that's why you can easily analyze that this led to a sharp decline in the value of currency. Between 1971 and 2008, the US dollar underwent a significant depreciation. And during this time frame, there were 5 cycles of short-term debt, each with an interest rate that ended lower than the one before it, which significantly boosted asset values. In 2008, as a result of global economic and financial crises, the interest rates drove to near 0%. This step indicated that the central bank would need to implement a new type of monetary policy in order to fuel the economy. So this phase is known as the final stage of the long-term debt cycle, characterized by rapid debt monetization. In 2008, this took the form of quantitative easing. The Federal Reserve began purchasing government bonds to inject money into the economy. This trend continued in 2020 when the government required more funds to provide stimulus checks, leading the Federal Reserve to print trillions of dollars and purchase government bonds. And, as expected, this led to a significant amount of inflation due to the increased spending. Moving on to the past couple of years, most of us are likely aware of the situation. In order to manage inflation, the Federal Reserve has been raising interest rates since mid-2022. This has led to a decline in speculative stocks and a generally poor performance of the broader market. So, where do we stand today? And what does Dalio think about which asset classes will perform well in the future? Well, the market currently has the belief that interest rates will decrease in the long term. Your opinion on this will determine how you perceive the market.
This market, depending on what you think this market is, it actually believes that inflation's coming down. And they don't believe Jay Powell to some degree.
I think what you're referring to is they don't believe what's in the curve. Or in other words, what's in the curve is a significant easing.
Yep. Right.
What Jay Powell is saying is steady.
Right.
Believe steady.
You're saying believe steady. You're saying believe what Jay Powell is saying.
Right.
And we know that short-term rates have significantly higher yields than long-term rates based on the pricing of the bond yield curve. However, this contradicts the message from the Federal Reserve's Jerome Powell, who has assured investors that rates will remain steady in the future, a view that Ray Dalio also agrees with.
But I think that this type of recession is not a bad recession. It's a lot less bad than I thought it would be.
Despite expectations of relatively high rates, Dalio believes that the upcoming recession in 2023 may not be as simple as he previously thought. According to him, the real issue with the U.S. economy is its enormous debt, which is becoming increasingly difficult to sell globally. This puts the Federal Reserve in a challenging position as they try to balance 2 key factors: inflation and the needs of debtors. On the one hand, the Fed needs to maintain an interest rate high enough to offer real returns that exceed the inflation rate, And on the other hand, they need to avoid raising rates too high for borrowers, such as businesses and governments who are already struggling with debt and facing rising interest payments.
So you're seeing this type of contraction. So it's going down, and we're having something close to a let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate,
right.
Something like that, right?
Towards the end of the interview, Dalio provides his viewpoint on which assets are likely to perform well in the current economic environment we face.
Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks.
Dalio has the belief that cash appears more attractive than stocks currently due to two main reasons. First, the real returns on cash have shifted from being negative to positive. In 2022, the annual inflation rate was much higher than the returns from a government bond, resulting in a negative real return after inflation. In the recent months, short-term bonds have actually offered a return that is exceeding the short-term inflation rate. Secondly, Ray anticipates further negative impact on the stock market in 2023.
Every investment is a lump sum payment for a future cash flow, and you put in the discount rate. So now you've moved the discount rate. That discount rate is not going to be materially changing, right? So we're not going to go back to the old discount rate, and prices are not going to go back to where they were. Then you start to have the knock-on effect on the economy.
And the relatively high interest rates also have an impact on future cash flows, the other component, whereby the higher interest rates mean that it can lead to a knock-on impact on the economy that can affect the businesses and their cash flows. Therefore, Ray Dalio believes that a combination of rising but stable interest rates with slow and stagnant economic growth will result in poorer returns for investors in equities from this point onwards. Again, I think that it is important to consider how this impacts investment strategies, particularly for value investors like me. I don't place much emphasis on macroeconomic predictions made by individuals like Ray Dalio, especially because at the end of the day, it is possible that equities as a group may not perform as well as they have in the past. There are still opportunities in specific sectors, industries, or markets that can provide strong returns. The key for a value investor is to identify these opportunities and invest accordingly. Furthermore, while Dalio provides excellent explanations for the economic machine, his track record on whether to invest in cash or not has been poor lately. For instance, at the beginning of 2022, he was still advocating that cash is trash, whereas cash ended up performing much better than stocks and bonds that year. Therefore, despite his current recommendation to invest in cash, it is possible that cash may perform worse than equities and even bonds. It is important to zoom out and consider long-term investments over a 10 to 15-year period or more. There's almost no scenario in that stretch where cash will outperform U.S. equities.